Good morning, everybody, and welcome to BCREA's webinar on the 2021 Economic Outlook and Housing Forecast. I'm your host and moderator, Darlene Hyde, Chief Executive Officer of BCREA. Thank you for joining us this morning. We have over 1,000 registrants registered in advance for this program. And we consider it a compliment that you've tuned in to listen to this particular program rather than the inaugural proceedings that are going on right now in Washington, D.C. So thank you very much for your vote of confidence. With widespread COVID-19 vaccinations on the horizon, many of us are wondering what 2021 holds for us and for the BC economy and the housing market. And today we're joined by BCREA's Chief Economist, Brendon Ogmundson, who is going to provide us with a look at the 2021 economic outlook and housing forecast. Brendon will discuss the 5 reasons why this year is looking considerably brighter than 2020 and what to expect from the housing market in the coming months. Now, a little bit about Brendon. Brendon specializes in macroeconomic forecasting, housing market analysis, and econometric modeling. He's responsible for producing forecasts for the BC, Canadian, and US economy and authoring quarterly forecasts for the BC housing market and the Canadian mortgage rates. He is also a member of the esteemed group, the BC Economic Forecast Council. On a more personal note, Brendon considers himself a Batmanologist. He can bench press 300 pounds. He's a Star Wars lover. He loves protein and a good book. So thank you for joining us today, Brendon. Now, before we get into Brendon's presentation, I'd like to go over a few housekeeping items. To submit your questions for Brendon, please use the Q&A feature at the bottom of your screen. As we have a large audience, as I've indicated this morning, we have disabled the chat feature and invite you to submit your questions using the Q&A function alone. We may also not be able to get to all your questions, so please upvote the questions you'd like to see addressed first. As we are not monitoring attendance this morning, today's webinar will not be eligible for self-directed PDP hours. This session will be recorded and a link to the recording will be included in the follow-up email. So I'm going to turn it over to Brendon now. Brendon?
Thank you, Darlene. That was funny. I didn't realize my personal details would be spilled for everyone, but thank you. That was funny. Let me share my screen. I think someone else has to stop sharing. Good. Yep. Here we go. Okay, so as Darlene said, I'll be sharing our economic and housing outlook for BC, and then really concentrating in the second half of the presentation on 5 reasons why I think 2021 is going to be a much better year than 2020, which might sound like a pretty low bar, but I think there are some really good reasons to be really optimistic about the economy this year and about the housing market. So we'll start with a look back on the year that was in 2020. This is what we call our nowcast. We call it that rather than a forecast because we're really just trying to estimate what's going on in the economy in as close to real time as possible. So we take every economic piece of data that's released for BC, roll it together with some math, and try and produce a number for economic growth month to month. You can see the damage that was done in the initial phase of the pandemic when we had sort of the first months of restrictions and a lot of just fear and uncertainty about how we were going to deal with the pandemic. At that point, you can see in like April, May, the economy was contracting at a double-digit pace, really kind of unprecedented in the historical record. But really since about the summer, we've had a pretty decent recovery. And we're at the point now where we're estimating that November growth in the economy is probably going to be in positive territory. Once we have all the data, we'll know. But clearly, we're into an economic recovery. So we are in a recovery. That recovery, though, is not going to be even. You may hear economists or in the financial media these terms thrown around when we talk about economic recoveries, whether it's going to be V-shaped or L-shaped. The most common a concept thrown around for this recovery is a K-shaped recovery, which is really like a combination of a V and an L. And it really gets to the point that some sectors are recovering really quickly. So if we look at something like residential real estate, we had a very sharp downturn, but then a very sharp recovery. So a traditional kind of V-shaped recovery. Other sectors of the BC economy, especially something like tourism, our borders are closed. So that sector is really continuing to struggle and is going to be lagging the rest of the economy for quite some time. So we're into a recovery, but not all sectors are going to be enjoying that recovery equally. Not only that, but for some sectors, recovery is not a smooth path, and we have these sort of false starts. You can think of the restaurant industry, especially. We look back to June and look across major Canadian cities, and it looked like things were starting to get back to normal in terms of people going out into restaurants. Restaurant reservations were recovering back to, I think, only down 40% instead of down 100%. But then as the second wave hit and COVID cases really picked up, we saw once again heavy restrictions, especially in places like Montreal and Toronto, and the restaurant sector kind of back to square one. So we are in a recovery, but that recovery is going to have sort of fits and starts. We see that even now in the Canadian economic recovery. The first quarter of 2021 is probably going to be a little slow due to the measures taken to combat the second wave. So again, point being, not a recovery, but not necessarily a smooth path. Comparing past recessions and especially impacts on employment, I think it's pretty startling to see the speed and the scale of job losses in 2020 compared to past Canadian recessions. Within about a month or two, the BC economy had lost about 15% of its employment. Fortunately, we as things sort of reopened and we've started to kind of figure out ways in dealing with the pandemic, especially in a safe manner. We have seen a pretty strong recovery back to about 98% of where we were in February 2020. So still kind of a long way to go. 2% of employment is still a pretty big number in terms of people unemployed. But we are going to slowly get back to our pre-COVID levels of employment. I think this year especially we'll see a real pickup in job growth in the second half of 2021. So point being, the economy in BC has likely contracted more than 5% in 2020, one of the most severe recessions on record. However, if you looked at the housing market, it would be pretty tough to see a recession at all. And in fact, much like this famous Marshawn Lynch stiff arm, the housing market has just sort of shoved the recession to the side. I'll leave this up here for a second for all you diehard Seahawks fans like me who are still sad about the early playoff exit and kind of need to reminisce on better times. So the housing recovery has been remarkably strong, and it's been remarkably strong across all markets. We see basically in every region across BC, home sales up 40 to 70% or more above their pre-COVID level. So not only have we gotten back to where we were before the pandemic hit, but we are seeing sales sort of setting record after record every single month in the second half of 2020. So really surprising that in a recession as severe as we've seen, we've also seen an enormous recovery in home sales and prices. We'll get to some of the reasons why we think that occurred. And I mean, obviously very counterintuitive to see such strong demand in spite of a severe recession. So the first off is pent-up demand. So if we just look at what happened to home sales in the first few months of the pandemic, compared to levels of sales we would normally see in those months, we estimate that we lost about 11,000 or so sales during the pandemic, or the first few months of the pandemic. So in that spring selling season where we typically see the most sales were about 11,000 below normal. By midsummer, we started to really catch up. So a lot of those sales that couldn't happen in the spring I think everyone on this call, all of the realtors on this call, did a remarkable job in really figuring out how to make sure that transactions could still happen in a way that really prioritized safety of your clients, safety of the public. And that meant more confidence in the market that transactions could happen. And we saw pent-up demand really start to hit the market in July, where from July to the end of the year, we saw sales that were about 20,000 above normal. So over and above any of the sales that we lost in the first few months of the pandemic. So obviously a little more than pent-up demand going on here. One of the other reasons, of course, is the really unusual and asymmetric impact of the pandemic on the labor market. So this is a really unusual sort of situation where we've seen high wage jobs, so the types of jobs that tend to support ownership housing, especially in more expensive markets, high wage jobs have actually seen employment rise 6% above their pre-pandemic levels. Usually in a recession, we get much more uniform impacts on jobs. And in fact, high wage and mid-wage jobs tend to be hit a little bit harder by recessions. This time around, high wage jobs didn't really feel this recession at all, whereas frontline service sector jobs, especially for younger workers, were really impacted. You can see that lower wage jobs actually were down close to 30% in the worst of the recession, have started to recover. But again, that's going to be a much more uneven recovery. So this is really one of the reasons why we've seen continued really strong demand for ownership housing, but maybe a bit more of a disruption in the rental market because of this divergence in employment growth between wage tiers. Another big reason why we saw such a strong recovery is that policymakers in Canada, especially the Bank of Canada, really learned a lot of lessons from the financial crisis and how to deal with potential financial crises and with recessions. In that they responded to this crisis with really overwhelming force and speed. So you saw that they lowered their overnight rate down to their effective lower bound, 0.25%, very quickly. And also, and probably more importantly, and in conjunction with the federal government, the CMHC, poured a ton of liquidity or just cash at Canadian credit markets. So that meant that the Bank of Canada engaged in what we call quantitative easing, or QE, where they buy billions of dollars every week of government bonds. Purchasing those bonds drives government yields down. Those are sort of the benchmark for all interest rates in the economy. As those yields were driven lower, you can see the 5-year Government of Canada bond at one point was driven down to, I think, about 0.3%. As those rates fall, other rates in the Canadian economy are pulled lower as well. So we've seen Canadian 5-year fixed rates fall to a record low of 1.8% for most lenders. Some have even lower rates, but average across the economy about 1.8%, about 70 basis points lower than its previous record. And that QE has been really important to the recovery. So we ran some simulations. Just assuming under a baseline that mortgage rates would have only fallen to their previous low of about 2.5%, with the QE driving rates even lower to an all-time record 1.8. We figure that added about 1,700 sales per month in BC. That extra stimulus from the extra low rates explains about half of the kind of outsized recovery that we've seen. So a really important factor. The policy response from especially the Bank of Canada has been really huge in driving the overall recovery in home sales. So that's the demand side. We've seen very strong high wage employment supporting ownership housing. We had all that pent up demand, record low mortgage rates driving sales higher. So we get the unusual effect of, in a recession, we actually saw a very, very strong home sales. What about the supply side? Again, a really unusual situation. Normally in a recession, what we would see as unemployment ticks higher, and this time around it hit over 13% at one point, normally you would see a real accumulation of listings an environment like that. So 2008, 2009, we saw a spike in listings on the market as people lost their jobs or experienced a loss in income. That's what our models tell us is going to happen as well. I mean, models are based on historical data, and usually recessions look like this. So if you just run a kind of normal model, it tells you that listings are going to react like that to high unemployment. This time around, though, instead we got a negative supply shock to listings. So instead of accumulating, what we saw was in the first few months, because of social distancing and general stoppage in activity, listings did start to decline. And then instead of rising as you would normally see in a recession, they sort of treaded water most of the year. And then as the recovery really picked up, all of those sales just continued to eat into total inventory. And we're finishing the year with active listings at close to a historical low. In some markets around the province, I'm thinking of places like Chilliwack and Vancouver Island and parts of the Okanagan, we're actually at record low levels of listings. So pretty remarkable. In a recession, we're seeing a positive shock to sales and a negative shock to supply, kind of exactly counter what we would normally see. One reason why listings, I think, at least in the first part of the year, remain so low is again because of very good government policy. This time around, it was the CMHC's deferral program, so borrowers could take advantage and defer their mortgage payments for 6 months. The Bank of Canada estimates that program probably prevented mortgage defaults from hitting a record high in 2020. Instead, we saw very low levels of defaults and very low levels of financial vulnerability for households. This was sort of referred to, though, this program was set to end in October, November, essentially. And so there was a lot of concern in that part. So the second half of the year of what was called a deferral cliff. So this idea that as these deferrals ended, households were still going to be in very bad financial shape and would start defaulting on mortgages or would be forced to list their homes. And that was really the biggest reason behind, I think the biggest reason behind the CMHC's forecast, where they were really expecting a lot of supply to hit the market very quickly, and to the point where if you look at their forecast, they were expecting home prices to be about $650,000 as for the average price in BC. Instead, we finished the year at $840,000. So, I think that's we all make bad forecasts in this business. But I think that missing what was really happening on the supply side is probably a big part of that forecast miss. So, in fact, as that deferral program was ending, we've just kind of seen a very quiet ending of deferral. So by October, there were only about, I think, fewer than 2% of insured mortgages still in deferral. In places like Victoria, it was even lower, I think 1% or less. So that program has been just sort of ending without any kind of disruption to the market. So certainly a story we talked a lot about or had to answer a lot of questions about in 2020 was what happens. What about the deferral cliff? What's going to happen on the supply side? We were always pretty optimistic that this wasn't going to be that big of a story. And so far, we haven't seen any disruption on the supply side at all. Another reason is really good government policy. So like the Bank of Canada, the federal government responded to this crisis with overwhelming force. We see in the second quarter, kind of at the worst of the recession, at a time when we saw huge declines in wages and salaries for Canadians. The government really made up that shortfall with billions and billions, hundreds of billions of dollars in immediate transfers to Canadians. So they got that money out really fast. One of the usual problems with fiscal policy is that it's slow. And this time, through direct deposits and just getting money out the door, they did a really good job, I think, in making sure, bridging Canadians financially through the crisis. Did such a good job that a lot of that money actually just ended up not being used. So a lot of it just sitting in savings accounts. So those transfers plus a lot of precautionary savings meant a huge buildup in savings, accumulated savings in Canadian households. So we'll get to that a little later, but that's a big part of the story for 2021. When asked what they're planning to do with those savings, most are either using that money to pay down debt, really shore up their household balance sheets, or just keeping it as precautionary savings. So the result is that we're again in this very unusual recession where instead of seeing consumer bankruptcies really spike, instead of seeing mortgage arrears climb like we saw in 2008, 2009, we're at a point where consumer bankruptcies are near a historical low, and mortgage arrears have nudged up a little bit, but still remain extremely low, especially for a recession. So we're coming out of one of the deepest recessions in BC history, but with households in really pretty good financial shape and with a lot of accumulated savings. Some households coming out of this recession perhaps better than they went into it in terms of ability to kind of withstand a shock to their income. So again, a pretty remarkable situation. And one of the reasons why because we're not seeing the usual financial vulnerability we would normally see, listings are really low. People have not been forced to list their homes on the market at fire sale prices. We've just seen listings really continually slide downwards to a point where we're sitting ending December at extraordinarily low levels, near historical lows in terms of total inventory. So that's one of the big reasons. Demand has recovered really strong. Supply is really low, so we're seeing some significant upward pressure on prices. The other big trend that we're seeing across all markets and some, especially outside the Lower Mainland, especially, is that buyers really want space. So we've seen the share of single detached sales climb to its highest in about 4 or 5 years, above 50%, 55% in some cases. We see this a lot in buyers obviously looking to avoid high density and looking for extra space. As it's easier to work remotely, we see people move outside the Lower Mainland. We're seeing a really high demand for acreage in places like the Okanagan, places where you can just get more space for your money. We're seeing really strong demand in those areas. That's driving detached sales higher. One of the reasons why the average price has hit a record this year and really has been kind of astonishing of the level that average prices in BC has hit is because those more expensive properties are a much larger share of overall volume this year. So we'll see if that trend continues. I think it really depends on how deep of a scar the pandemic is going to leave on kind of the psyches of buyers. I think we'll still see really strong demand for space in the years ahead as people anticipate perhaps another pandemic happening at some point in the future. They're really going to want to make sure they have space. That's really going to continue to drive demand for single detached homes. So that kind of sets the stage for this year, for 2021. We're starting the year with a level of listings that's about 30% below normal, a level of sales that's about 60% above normal, and therefore kind of months of inventory that's close to 60% below where we would need things to be just to be in balance for prices to kind of grow in line with inflation. What does that mean historically? Well, if we just plot the sales to active listings ratio against a change in price, when we have market conditions that are this tight, we tend to see significant upward pressure on prices in the double digits often. I think that's what we're going to see the first few months of this year, at least until things start to normalize and we get some supply online. I think we're going to start the year with really tight markets and some real upward pressure on prices. Okay, so that's 2020. We'll leave that fiery wreck behind. Emerging much like George Clooney here, looking a little haggard, more haggard than usual. But I think some real reasons for optimism in 2021, which we'll get to right now. Number one, the thing we were kind of waiting for what seems like forever, vaccines. We have effective vaccines. Many different effective vaccines have been approved. That's really the big story for 2021. Two, I think we're about to see consumption spending in the economy, so household spending really take off this year. Three, I think really good news on trade and immigration. Four, resumption of major capital projects, which were a huge part of the growth story in 2019. And five, what's going to happen with interest rates? How do we see that evolving? So number one, vaccines. So a pretty aggressive vaccine plan for Canada, looking to have everyone who wants one inoculated by September. I think there's going to be a ton of political and media pressure. You're already seeing it now. I mean, it's in perspective. We've only had available vaccines for like a month, and we're already, and there's been some disruptions to the rollout. It's not going as well as we would like, but we're already seeing a ton of media and political pressure. I think that beyond the kind of hiccup that we've seen where we're not going to be receiving vaccines the next week, I guess I think we're going to see a ton of pressure to really ramp up that rollout over the next month. We're supposed to get all of our initial allotment by the end of the quarter. I think by April, we're going to see a real ramp up in vaccinations, and hopefully a real push to actually get this immunization plan ahead of schedule. Here's how things are going so far. With kind of a first run from vaccine manufacturers, Canada's at about 1.7%. Around in the top 10, but near the bottom of that in terms of vaccination, the share of the population vaccinated globally. BC has used, I think, about 90% of the doses it's received. If we look at what this really means, though, look at modeling by epidemiologists, using deaths, as the best statistic for COVID-19. Past March, April, we're going to start seeing some really good news in terms of really bending the curve, really getting caseloads down to really low levels, getting deaths to hopefully as close to zero as possible. So kind of back to where we were in early summer, where things really quieted down, except with the added benefit that we have vaccines and we have sort of the ability to really put the pandemic behind us and really eradicate COVID-19 and really get back to normal. And that getting back to normal, I think, is going to unleash incredible confidence and optimism in the economy. And that's going to lead to a lot of pent-up spending. So our second big factor, reason for optimism, is a projected consumption boom in the economy. This is something that's already underway. If we look at things like retail sales, we're already seeing double-digit year-over-year growth in retail spending. A lot of that is driven by interest rate sensitive sectors like automobiles, so new car sales, but also home renovations and furniture purchases. People have been stuck in their homes for the past year, and they're kind of looking around at things to change and things to spend their money on. So we're really seeing sectors related to home sales, especially, really climb. And again, we have all that savings that we discussed earlier. Second quarter, we saw a 30% savings rate across Canada. Normal for the past several decades is under 5%. The last 2 quarters, we've seen double-digit savings rates, including an all-time record in the second quarter. And all of that money being saved is just sitting in the personal deposits of Canadians. So there's about $75 billion or so of just excess savings sitting in bank accounts, really waiting to be unleashed on the economy. A lot of that money is going to find its way into consumption, but into home purchases as well, into down payments for homes. And so we expect all that pent-up spending to be really unleashed in 2021, all that savings to really flood into the market. So we're kind of forecasting 4 or 5% consumption growth in the next year. Number 3, so global factors. Obviously, a lot of strength on the domestic side of the economy. What about global factors? One, I think we're going to be seeing rationality returning to the global trade environment. I'll let you fill in the blanks on why that rationality is returning. It has something to do with the events of this morning. But we're going to see an end to needless trade wars, an end to tariffs, and that's really going to be a good news story for an open economy like BC that relies on export markets. We're already seeing a strong turnaround in exports as the global economy starts to get back on its feet. I think overall we're going to see much stronger trade growth and much fairer trade growth over the next year. And then on the immigration side, 2020 borders were closed. Immigration was very low. Therefore, as the largest driver of population growth in BC, population growth was low as well. But the federal government has set very aggressive targets for immigration in 2021, 2022, and 2023. Targets of over 400,000 new immigrants in each of those years. BC tends to get about 15% or so of that target. So we're expecting very strong immigration numbers in the next 3 years, and therefore very strong population growth. Maybe that immigration story is a bit more focused towards the end of this year and early 2022. We still don't have open borders, and there's probably a huge backlog of immigration to get to. But clearly a very strong driver of demand over the next 3 years. As our population grows, that's just going to increase demand for homes, which is really kind of a bullish indicator for home sales over the next 3 years. And then, of course, the tourism sector. So just as everyone on this call, I'm sure, can't wait to take a vacation, either outside the province or outside the country. There are just as many people around the world waiting to visit BC and to visit Vancouver. There's 70% of people are expecting to travel as soon as the pandemic is over, and so that's tourism is about $8 billion a year for our economy, about 3% of the BC economy. So once borders open, tourism starts to rebound. That's just one more part of the BC economy that's going to be firing again. Number 4, major projects. So this is a really big story, especially for the north, where we have the major LNG projects underway. This was a huge part of the growth story for the 2019 plus period. Of course, because of the pandemic, a lot of those projects had to be tools down in 2020. So we did see a pullback in capital spending. But as things get back to normal, those projects are back up and running and really starting to ramp up that spending once again on operations and construction especially. We're expecting to see something like 20% growth in capital spending in 2021. In 2019, spending on those projects alone accounted for about 2% of that year's 2.7% in economic growth. So over 2/3 of growth in 2019 came just from those large capital projects, especially in the north. As we see those projects get back up and running, we're expecting to see a similar impulse to growth in 2021 as they kind of try and make up for lost time. So taken together, really strong consumption growth in 2021, strong immigration, the export market kicking into high gear, major projects once again contributing a huge amount to real GDP growth. We're expecting that the economy is going to really rebound this year, growing 5%, perhaps a little bit more in 2021, the strongest growth in a couple of decades. So again, really strong economic growth in 2021 means strong income growth, strong employment growth, all things that tend to drive really strong housing demand. And then finally, I think the most important factor is interest rates. Right now, you can borrow for 1.8% for 5 years, with inflation, kind of medium-term inflation expectations around 2%. That essentially means you can borrow for free for the next 5 years. No surprise that that's a huge stimulus to the housing market. But how long are those low interest rates going to be around? So just this morning, the Bank of Canada reiterated its commitment to keeping its overnight rate at its effective lower bound, 0.25%, until 2023. Even with we ran simulations in our own macro models, fits exactly with what the Bank of Canada is saying. Our baseline is that slack in the economy, or the output gap. So the difference between what the economy is currently producing and what it can produce when it's kind of fully operational, will kind of be back to zero around 2023. That's usually a sign for the Bank of Canada to raise rates. That's what they're looking for when you hear them say, we're keeping our overnight rate low until slack is absorbed and inflation's back to 2%. They're talking about the output gap being zero. Even with a much faster recovery, we would still probably only see rates start to rise towards the end of 2022 into 2023. So there's a pretty deep injury to the economy. You can see how deep that output gap was at one point. It's going to take a long time to get back. So 2023 seems like a pretty good benchmark for how long rates are going to stay at their current lows. What about negative rates? I usually get this question. If you haven't got negative yet, very unlikely that the Bank of Canada ever will. And for a few reasons. One, there's an emerging literature that negative rates aren't really that helpful. So the impact of negative policy rates actually after the second year of those negative rates tends to actually lead to negative loan growth. So banks not lending money or lending less money than they had before. And so what the Bank of Canada tends to say is that negative rates are really disruptive, especially to the banking sector. And they sort of say it's in our toolkit, but it's not one we're looking to use. So that question usually comes up. So thought I'd cut it off the pass. Although they're not looking to bring rates into negative territory, the Bank of Canada is continuing to engage in quantitative easing. So once again, that's buying Government of Canada bonds to force interest rates lower. You can see how extraordinary that those bond purchases have been in the expansion of the Bank of Canada's balance sheet. That big spike there is the beginning of quantitative easing. Though that, of course, will keep rates very low. And it's kind of the one factor where as the economic recovery in Canada progresses, they will start to slow that spending. That's probably pretty unlikely until the economic recovery is well underway. So we're gonna have to see several quarters, maybe a year and a half of very strong growth before the Bank of Canada considers tapering that program. What that means for mortgage rates is, at least through all of this year and through much of 2022, we're going to see very, very low, probably sub 2% Canadian 5-year fixed rates. Maybe a bit of an uptrend towards the second half of 2022 in anticipation of that tapering, plus in anticipation of the Bank of Canada eventually tightening in 2023. So we have these very low mortgage rates. Record low mortgage rates are going to be around for quite some time. And we've already seen how stimulative those rates have been for home sales. So one more reasons why we're very optimistic about the housing market this year. So to kind of wrap up the economy, I think in 2021 is going to be running on all cylinders. All that pent-up savings will be unleashed into the economy, into the housing market. Immigration's normalizing to higher targets. Mortgage rates we expect to remain low at least till 2023, and all of that really strong demand is happening at a time of record low supply in a lot of markets. So, is there some historical precedent for what we're seeing right now? Looks a lot to me like 2015 to 2017, also a time when mortgage rates had hit a record low, at that time 2.5%. We saw record sales in a lot of markets in that period. 2016 was a record for the province, but we saw really 3 years of really strong sales. Looking at on the pricing side, it looks, this is from some work we have forthcoming, trying to decompose prices over history into different pressures from different directions. This to me looks a lot like this period. So At that time, between 2015 and 2016, pre-foreign buyers tax, we had very little supply in terms of listings. We had record low mortgage rates and some demand pressures. I think this time around, we have a lot of those ingredients: record low mortgage rates, very low supply, and probably even more demand pressures as the economy recovers. So all that to me says we're going to have really strong upward pressure on prices, at least until we can get some supply coming online. So our forecast for the year then, we're expecting about 109,000 sales this year. The potential that we hit a record, depending on really how strong of a spring season we have, how much momentum really carries through this year. Bit of a pullback to just under 100,000 in 2022. Average price we expect up about 8% this year. And then as some of that supply starts to come online, markets kind of fall into a bit more balance, and we get something closer to about 3% growth in 2022. So anything, if you're looking for our forecast, our nowcast, our reopening dashboard, our stats releases, I'm sure most of you know where to go, but all of the stuff that you kind of find here, our market intelligence, you can find at our website. And with that, I'm looking forward to taking some questions.
Well, thank you very much, Brendon. That was a great presentation. I love the videos of the basketball shots and the football shots. So that was great. We now get to the Q&A portion of today's webinar, and I see some of these questions coming in. Please submit your questions under the Q&A feature, and remember to upvote questions that you'd like to see answered first. First of all, the slide deck will be distributed with the material going out tomorrow, so that's coming your way. Now, there is a question. I think you've dealt with it a little bit, Brendon, but I think it bears repeating. With the low interest rates that we've had, even before COVID, will inflation be a problem in upcoming years? And number two, if rates, and you said, rates will hold till 23, but if rates were to go up by even 1%, is there the capacity for the consumer to tolerate that increase? So that's the first set of questions.
Thank you. On inflation, inflation is still really, really low. The best guide to inflation is really the output gap. Inflation tends to move with how much of the economy is kind of being utilized. We're at a point still where we have a really negative output gap and still, therefore, a lot of downward pressure on inflation. I think, it's going to take a while just to get back. When we run our simulations, inflation gets back to 2% kind of sustainably in 2022 or so. So I don't expect inflation to run much hotter than that. And then if it does, the Bank of Canada will be on it, which leads to your second question on the ability for markets to withstand an increase in rates. So this is really interesting because I think for me, the lesson of the past 10 years has really been that the only thing that puts much of a dent at all in the housing market is our interest rates. So we saw this in 2018 when rates started to rise and approached 4%. And with the stress test, that means qualifying at close to 6%. That had a huge impact on the market in 2018, 2019. We're a really long way from that period. And we even saw the Bank of Canada really struggle to get its overnight rate even closer to 2%, the last tightening cycle that we had. So there's a lot of evidence that sort of what we would call our neutral rate, or where rates are going to, or sort of, in the kind of Goldilocks scenario, neither too hot nor too cold, that the economists refer to as a neutral rate. That's probably even lower than 2%. Maybe it's 1.5%. So I think the ultimate destination for rates is probably going to be much lower than a lot of economists used to think. And so I think we're in a situation where I don't expect that much upward pressure on interest rates over the next 3 years. And even, a slight uptick from here is not going to make much of a difference. Even a 1% increase brings us back to very low rates from where we are. So, basically, if we went up 1% on the mortgage rate, we're going from 1.8 to 2.8. I don't think that's going to be too difficult for households to absorb.
Hey, thanks, Brendon. We have another question, and I'll rephrase it a bit. We've got low interest rates fueling sales activity, but you've also got supply constraints producing price increases. Do you think this will cause concern to government policymakers in terms of the price increases?
Yeah, I mean, it certainly has in the past when markets have, when we start to see upward pressure on prices, we start to see a lot of media discussion of those of the difficulties that sometimes that causes, and then we get a government policy response. I'm not sure what else they can do, like what else they have in their quiver at this point. We've seen so much demand side policy from governments at all levels that I think has shown that the best that a lot of that policy does is buy time. We have very temporary impacts from all of those policies where you see, a 6 to 8 month kind of dip, and then we're right back to where we were. I'm hoping instead they really have learned some lessons themselves from how temporary the effects of a lot of demand side policy are, especially in a market that's really undersupplied, and they start to really look at the supply side instead and focus policy there, so we can start to get some balance in markets, because it's not healthy for markets to be rising sort of 10% a year. We need some balance in markets. We need more supply in markets, and especially in a lot of markets outside the Lower Mainland, where supply of listings has never been lower. We really need to be able to get supply to those markets, so we don't see a lot more challenges to affordability.
Okay, thank you. Now, here's two questions. Actually, they're related. One is about what do we see for like the downtown core condos? Like, what is going to happen to them? But the converse to that question, or the other side of it, is what is happening by way of shifting housing to the non-metropolitan areas of the province, the exurbs, the suburbs, and whatever. So the two are kind of related. What's going on there in terms of consumer preferences and movement?
Well, I'll deal with the downtown part first. I think like most downtowns or most big cities, Vancouver is seeing, Toronto is the same way, real disruption to its rental market and to its condo market. We had for much of the year, we didn't have foreign students or students in seats at universities at all, who usually take up a lot of those units. But I think a lot of that is temporary weakness. So as the economy heals, as we get back to normal past the pandemic, I think young people especially are still going to want to live downtown. Students are going to come back. We have really high immigration targets. We have a really young population, so the millennials are aging into their household forming years now. We tend to think of millennials as kids, but a lot of them are in their 30s and kind of entering their prime earning years as well. And a lot of if they're going to be in Vancouver, a lot of what they're going to the most affordable part of the market is the condo market. It's really the only achievable part of the market for younger workers. So I think downtown and the condo market in general in Vancouver is going to be fine. It's just going to take some time to get back to normal. So maybe 2021, end of 2021, 2022. But I think it's going to be really strong, essentially, since it's really all that we build now and all we really can build in Vancouver. So going forward, so that part of the market I think is going to be fine after some disruption. As far as outside the Lower Mainland, again, it really kind of depends on how we've seen a lot of retirement plans accelerated by the pandemic, I think. So people that might be relocating to the island or the Okanagan or outside of Vancouver in the next 5 years or 5 years from now have decided to do it now instead. They can borrow extremely low rates, or they can work remotely for the last few years of work before retirement. And so, it really depends. Again, like, are buyers really going to be still wanting that space after the pandemic's over? So how much of a scar, again, is on the psyche of buyers? How much sort of demand is really going to be pushed by sort of that behavioral response to the pandemic? I would guess we're going to see that for a few years at least. But again, there's not a lot of single detached homes, outside the Lower Mainland, maybe more, but within Metro Vancouver, it's certainly a shrinking part of the housing stock. So we'll see. I mean, it plays in also to the fact there's a lot of baby boomers that are retiring. So with this sort of double kind of wave of millennials looking to buy homes for the first time, and baby boomers starting to retire and maybe looking for places outside the Lower Mainland. So I think those trends are kind of be around for a while, even after the pandemic.
Okay, thank you, Brendon. Well, today Joseph Biden got inaugurated, and he has said that one of his first acts by executive order will be to rescind the Keystone Pipeline. What impact, if any, do you see this having on British Columbia economy?
So I anticipated this question, so I'll just quickly share a slide I have about it. All right. Okay. So yeah, obviously this has much more of an impact on the Alberta economy than the BC economy, and it's certainly hitting Alberta at a time when investment into the oil sector is already very low and has been sliding ever since 2014. One of the things about Keystone especially is that because it supplies mostly the U.S. market, which is a flatlining kind of oil consumption market, a lot of the market really wasn't that behind that project. So that's why we're not seeing a lot of investment into that project or into projects to get oil to the United States. The really big play on the energy sector is still Asia Pacific. You can see how much demand or consumption of oil is happening in the Asia Pacific region, especially. It's projected to be growing much faster, which is why projects like the Trans Mountain Pipeline are kind of seen as much more viable projects because it gets oil to markets that really want it, versus Keystone, which is sort of seen as not really as necessary, and maybe they won't even have enough of the supply to really fully utilize it. So obviously a big blow to the Alberta economy, and we could see an additional sort of impact. They took away Keystone. Maybe that means they give Canada something else, like we get rid of forestry tariffs on softwood lumber. Mm-hmm. So we could see some benefit for the BC economy from that decision, potentially, kind of indirectly. But as far as a direct impact on BC, I don't think it's going to be that important.
Okay, thank you, Brendon. Here's a question on the stress test. Do you think any kind of changes are in store for this in future?
So everyone probably remembers that the stress test was set to be altered in April of 2020, at least for insured mortgages, and probably there was no ways that for B20 for uninsured mortgages as well. B20 is a terribly written rule where the stress test defaults to the posted 5-year rate if your kind of market rate plus 2 is under the posted rate. That posted rate doesn't really change. So I think in my slides on interest rates, you can see that the 5-year posted rate is still at 4.79%. It only came down about 30 basis points at a time when other interest rates across the economy hit all-time lows. It's just not responsive to market conditions at all, which is why it was going to be changed, because policymakers realized, this isn't really working the way we thought. And unfortunately, the pandemic hit, and that rule or that change was shelved indefinitely. We're at a point now where the market's really strong, and as much as I'd love to see them correct how poorly written B20 was, I don't think it's their number one priority to add further stimulus to the housing market. So it would be great if they did. It would be fair if they did. I just don't see it as a high priority for them right now.
Okay, thank you for that. You've talked about the Keystone XL pipeline and its impact primarily on Alberta, but from the larger perspective, do you see any impacts on the Canadian economy and BC in particular from the new Biden administration?
Yeah, I mean, I think I alluded to in my reasons for optimism. One of them is just having a normal trade environment. It's nice to have our largest trading partner not be so hostile, and so that alone, I think, should be a real boost, especially to, Canada relies on exports, BC relies on exports. I think having a trading partner, our largest trading partner, engage with us on good faith terms is going to be good for growth. And I think that's one of the largest benefits from that changeover. Plus, means we'll probably get a lot of government stimulus in the United States over the next year. What's good for the United States economy tends to be good for the Canadian economy. And so, one more reason to be optimistic.
Thank you. Here's another question, and it is kind of the interplay between vaccine distribution and immigration. Now, you mentioned some fairly ambitious immigration targets in the coming years, in fact, this year. But we've seen vaccine delays, maybe until September, October. Do you think the vaccine delay may impact the immigration target achievement?
Yeah, in the sense that it affects when our borders open, and what's out of our control is how that vaccine rollout goes in other countries. Because obviously, if they're not doing a good job vaccinating, we're not going to have our borders open to a lot of countries where they're not approaching herd immunity or reach herd immunity. So, yeah, they go hand in hand. We can't open our borders until we have really strong results on vaccination. So any delay is going to delay some of the positive benefits, which is why I think the immigration part of that story maybe is a later 2021, 2022 story.
Okay, thank you. Here's another question, and it kind of ties in with, there's two questions, and I want to knit them together. One is, where are the prices going to end up? Like, they seem to be going up and up and up. And the other question is, what can be done and what can we recommend to policymakers around the supply issue that could ameliorate some of the price pressure?
Yeah, because we're starting the year at such low levels of supply, and my favorite example is Chilliwack, which finished the year at about 450 total listings in a city of over 100,000 people. That's probably my favorite example of a place that has no supply at all. Vancouver Island is like that as well, where we're at 20-year lows essentially. And that's what we talk about listings. And so there's a really interesting thing happening. And again, I've got a slide about it. If I can find my mouse, where the listings as a share of the housing stock are just really low. And they've been low for a while. Now, of course, my slide doesn't want to share. Listings as a share of the housing stock has been kind of on a downward trend for a long time. So people just aren't listing as much as they used to. They're not responding even to high prices as much as listings used to. I think part of that's demographics, in that we have a lot of baby boomers that instead of downsizing are opting instead just to stay in their homes. And so we're not getting the bump in kind of listings we would normally be seeing. And so supply just hasn't ever been able, because we also have a lot of really strong demand pressures over the past several years. Listings have just never been able to get back to normal. I mean, we saw even in a severe recession, we were way below not just where we peaked last time in a recession in terms of listings, but also very low just in general kind of terms. So how do we get more listings to market? I think the only thing that really comes to mind, we just need to build a lot more. We need to really increase the housing stock enough so we have a lot of choice out there. Because right now, listings are just really low, and they've been on a downtrend for a long time. And even with these huge economic shocks, we're still seeing extraordinarily low. So the only thing we can I think do is get supply to market and get it to market way faster than we're currently doing, because we have no ability to match demand that changes really fast with supply right now. It just takes too long. And then that's one of the big reasons why we keep seeing over and over these supply crunches.
Well, thank you, Brendon. Yeah, and I would say that if we could get messages to municipalities to streamline their permitting processes and their general processes for bringing homes on the market, that would help. We reached the witching hour here. Thank you, everybody, for joining us this morning. And thank you, Brendon. Once again, the recording of today's webinar will be included in the follow-up email. If you have further questions, please don't hesitate to reach out to BCREA at bcrea.bc.ca. Thank you again. Stay safe and healthy, everybody. Bye now.
Thank you.